Hold on to your seats because BlackRock is saying this recession will be unlike any other, and what worked in the past won't work now. So what does this mean? How is this recession different than recessions of the past? Let's dive in. So BlackRock, the world's leading asset manager, is stating that this time around, when it comes to a recession, central banks can step in and save the day like they did in the past. And over the last 40 years, that's what they've been able to do. And the global economy has already exited a 4-decade era, 40 years of stable growth and inflation, to enter a period of heightened instability. So in the past, when things were rough, central banks would be able to lower interest rates. How does this help? Well, when interest rates are low, it makes it a lot easier to borrow money. So if people can borrow money, they can go out and spend, buy cars, houses, luxury goods, whatever they want. And on the opposite end, all of these businesses selling these goods are making a lot of money. They're doing well. And if they're doing well, they're able to hire employees. And also, if these companies are public and they're making a lot of money, making a lot of sales, their stock goes up in value. Everyone is happy. But on the opposite end, when interest rates are high, it makes it harder to borrow money. So if it's harder to borrow money, less people are out spending. And if less people are spending, companies are making less money. And if companies are making less money, they're going to have a hard time keeping their employees. They have to lay them off. And if these companies are public, because they're making less sales, this will take a hit on their stock. So when interest rates are high, everything goes down the drain. So wouldn't the central bank just step in and lower interest rates? Well, this time they can't, because inflation is already sky high. And if interest rates are lower, along with money printing, this will cause inflation to get out of control. And right now, as I make this video, inflation is already out of control. The Fed cannot simply lower interest rates this time around, because if we look at inflation in June, it reached 9.1%. That was the highest in more than 40 years. And if we look at inflation over the last 12 months, it is at 7.7%. Inflation is already sky high, and lowering interest rates this time around is not an option. Same thing for money printing. And when we look at the Fed interest hikes, they are at record numbers. And we saw in March of 2022 a 25 basis point hike, and then in May a 50 basis point hike. And a 50 basis point hike is very high, and people were pretty shocked. And then following that, we saw a 75 basis point hike, followed by 75 again, and again. And interest rate hikes have been so high that we have basically become conditioned to think that these are normal. If, for example, at the next interest rate hike, it's only 50 basis points, a lot of people will look at that as it's bullish. And while that is lower from 75 basis points, it's still extremely high. But like we said earlier, central banks cannot simply drastically lower these interest rates, because it will lead to even further inflation, and we are already experiencing such high inflation. And this is what happens when we print trillions of dollars over a very short period. And on top of central banks not being able to drastically lower interest rates or print their way out of this recession, BlackRock also noted compounding the issue is aging workforces around the world, which is one key reason that the supply of US labor is struggling to keep up with demand. This is very big, because when we look at economies and growth, at the core of it all is people working, producing things. So if there is an aging population, of course, this is a big problem. And with all of these issues, it's going to change the way we invest in 2023. Because, quote, central bankers won't ride to the rescue when growth slows down in this new regime. Contrary to what investors have come to expect, equity valuations don't yet reflect the damage ahead. So BlackRock is stating that if you believe what we're seeing now is the bottom, they claim that it's only going to get worse in 2023. And quote, the old playbook of simply buying the dip doesn't apply in this regime of sharper trade-offs and greater macro volatility. But this doesn't mean that BlackRock is claiming everything will go to zero. They are talking about the overall market as a whole. But they did state, to navigate the coming storm, BlackRock recommends more frequent portfolio changes and taking a more granular view on sectors, regions, and sub-asset classes. What this means is that BlackRock is stating, don't look at the stock market as a whole. don't even look at certain sectors in the stock market. Instead, have a very granular view, a very detailed view into specific companies. This, though, is very difficult to do even in a bull market. So in a bear market, it's very, very extreme. So while the overall stock market, and I'll add crypto and even NFTs, is facing a lot of danger over the next year, it doesn't mean everything will go to zero. We have already seen in this bear market, when it comes to stocks and crypto and NFTs and other asset classes, that within these classes, there are those that perform very well. But again, they are very difficult to pick. And other big banks share a similar view. For example, Goldman Sachs CEO David Solomon sees just a 35% chance that the US economy avoids a recession. And Bank of America, along with Morgan Stanley, are expecting stocks overall to crash more than 20% next year. So these big banks have a very poor outlook on the global economy in 2023. But while the overall market may go down according to these banks, there will still be those that perform well if someone takes a granular view and picks the right assets. And I want to know from you guys, do you agree with these big banks? Are they making valid points, or are they being overly dramatic? Comment down below. Thank you for listening, and I'll see you next time.